Now, as I mentioned, we were assessing the results of our responsible investment survey early in 2020, and I was really lucky to connect with our next guest, Peter Uhlenbruch, in London, who was actually at the same time involved in their research into a responsible investment survey as well. Now, I was ecstatic to discover that Peter's RI survey was very similar to the work we were trying to do, and we had a really good chat and understanding of the differences between what we were trying to do. Now, albeit their survey and report was on a much larger scale than our own, and Peter will dig into this for you in a few moments during his presentation. Company Peter works for is called ShareAction. ShareAction are a non-profit organisation that has been around for 15 years now, and their objective is to use a very impressive toolkit of research, corporate engagement, policy advocacy to advance or stimulate responsible investing through the investor universe. Peter is head of shareholder investor standards, at ShareAction, and he leads the investor engagement relating to their global investor surveys. Now, part of the research survey that they recently did through asset managers was that Peter, in the follow-up to that survey, he was engaging with all of the fund managers that completed the survey on an extensive basis, I think across 50 asset managers, to help him build out what would be a view of the best practice within responsible investment. As I mentioned, the ShareAction survey was on a much larger scale to our own, covering 75 of the world's largest asset managers. And see if you can get your head around this. Those asset managers control more money than the GDP of the US, China, and the European Union combined. Now, on that note, I'm going to hand over to Peter to take us through his slides. Peter, thanks very much for joining us, and I hope you can hear us.
Thanks, Rob. I can hear you loud and clear. And thank you for the warm introduction. It's an absolute privilege to be here with you today and to discuss some of the findings of our own asset manager research. Yeah, you're right. We have a global focus with our investor rankings, but I think the findings and the takeaways and the key messages are relevant for all regions. So I'm also ecstatic to share some thoughts about what responsible investment could mean in South Africa and what important next steps can be taken. And love to get your thoughts at the end of my 20 minutes around some of the themes. So yeah, ShareAction, we're a responsible investment research charity. We're based here in London. Our driving vision is a global investment system where all investors not only consider financial returns, but also the real world impact of those investments on both people and planet. And Rob, you're absolutely right. There is no planet B. We have to take care of it, and investors have a key role and responsibility to make sure that we not only reach a Paris-aligned pathway, but also do everything we can to meet the Sustainable Development Goals and help avert the biodiversity crisis. And part of what we wanted to do, and you'll see on this slide, the title of the research we published last year is called Point of No Returns. Very cheerful movie like Lord of the Rings, Return to Mordor theme style there, but I'll try and keep it as light and inspiring today as possible. But we're trying to build a standard for responsible investment that's fit for the challenges of the 21st century. And I'll go into a little bit of detail about what exactly we looked at and what we mean by responsible investment. So just to quickly go over the 75 world's largest asset managers, just to show that it's a truly global perspective of the research that we undertook, and participants were evenly spread across the Americas, Europe, and Asia Pacific. And in terms of what we wanted to explore, we developed a very comprehensive questionnaire, I think at least 40 very detailed questions across these four themes. And we think anyone who really claims to be a responsible investor should be having a strong approach to each of these four areas. The first is responsible investment governance, and we captured a lot under that theme, we looked at accountability. We looked at the quality of sustainability training for investment staff. We looked at financial incentives and how they're aligned with sustainability objectives. And also voting and stewardship was a big part of that. And we're going to focus quite a bit on voting and stewardship in my thoughts later on. And for the other three issues, arguably all systemic, particularly climate change and the biodiversity crisis, and now with COVID and the pandemic, it has really shot the S of ESG into the spotlight. And there's a lot more focus now on what investors are doing to ensure human rights are respected in the companies they invest in and throughout the supply chain. So where we looked at the quality of policies, their underlying commitments, the quality of stewardship, risk management, and what kind of data and metrics are being used. So a lot of information that we picked up in our assessment. I popped this slide up. I thought it's really important to note that we were blown away by the strong level of participation. We had 92% of the asset managers either disclose directly to our pretty lengthy survey, or at least review the survey response. And I think that's telling. These asset managers, they want to make progress. They want to know where they stand, and they were very supportive with this process, much to our delight. So just a quick note on that. And I won't go into a lot of detail about the findings themselves. I'd invite anyone interested on this event to visit our website and to read through those reports that we published early last year. But just a quick reflection that of the 75 asset managers, what happened is that we once we had the data, we assigned a rating from AAA, which is best in class, all the way down to D and E. D designates business as usual, and E is when there's no information whatsoever. But the majority of asset managers are still very early on their journeys when it comes to these topics. So the sector has a way to go. But more promisingly, for the 25 asset managers that did quite well, we noted that they came in all shapes and sizes. So I think it's a key point to make that no matter if you're a passive house or an active house, if you focus on equity or fixed income, how big, small, or where you're from, leadership is possible, and we have seen it across these characteristics. So this should be a little shining beacon for everyone in every region to know that leadership is possible. And Rob, you did note that we did a lot of heavy lifting with asset managers on the back of the ranking. What we didn't want to do was publish the ranking, get lots of press, do the naming and faming and shaming, and then walk away. We want to work very clearly with industry to give them decision useful feedback and to support them directly to improve their underlying practices. And we send very, very detailed and granular feedback to all 75 asset managers, as well as recommendations. And some of these recommendations I'll be talking about in a few minutes. And we sent all this information out, and we said, would you like to have a call? And I think we're expecting maybe 5 to 10 to get back to us. We had over 50 calls, 1 hour long, going into tremendous detail with very senior representatives from C-level to heads of, and in some cases entire ESG departments, and had really strong constructive discussions about some of these topics. So we were really, really happy to see that level of willingness to learn from our research and find out where the gaps and the opportunities for improvement are. So just to note on that. A little plug from the ShareAction side, and I think this is going to be a report that's going to be really valuable to a lot of people on this listening in right now. It's a leading practice guide. So this comes in the spirit of wanting to support industry to drive better standards. We looked at the best performers in the survey and their 2020 reporting last year, and we're going to feed back short practical case studies and links to public documents on what good looks like across all of these topics. So in the 1st of March, we're looking to publish that, and really look forward to sharing that. And I'll be sharing a few examples over the next few minutes to give a little sneak peek into that. So now is really the fun part. The most important part is, well, what could the South African responsible investment landscape learn from our research, and what next steps could they take to make progress? And I'm going to make a few remarks on a few topics. I'm going to start with the responsible investment governance, because it's so important. And responsible investment shouldn't be something just given to a junior analyst who sits in a department on the side. It should be toned from the top with leadership from the highest levels. So we certainly like to see accountability for ESG at senior executive and board level. So something to think about in your own firms is, where is accountability, and should it be higher, and it should be very high. Related to that is training, and the mindset of an investor today is radically different from the mindset needed 20 years ago. Now we've got systemic crises breathing down our necks that demand that investors think seriously about climate risk, physical and transition risks, that they really look ahead in terms of decades, but take action now. The biodiversity crisis that really demands a certain level of knowledge and expertise to take appropriate action, and also on human rights. So the training requirements for investment staff need to be better. They need to be more systematic. They need to bring in experts from climate science and from other sciences, and to make them appropriate for investment decision making. And we'll be featuring Aline Spernstein do a pretty good job of this. Have partnered with an academic institution in the States to provide a curriculum for their staff that brings in climate science expertise and makes it relevant for portfolio management and investment decision making. And ideally, we'd like to see this training also mandatory and to be undertaken at board levels, so that there really is that organizational-wide awareness and ambition. The third point is incentives are key. So the sooner asset managers start aligning their own remuneration structures with sustainability objectives, the better. We're hearing a lot of noise from the industry that we have ESG in our DNA, it's in our blood, it's in everything we do. Well, if that's in the case, we'd like to see that in the financial incentives made quite explicitly. Not many are doing this yet, but some are. And one quick example is there's a large Canadian asset manager, CDPQ, that have set carbon budget targets for different asset classes, and variable pay is tied to carbon reduction performance, and it either goes up or goes down. And this is, I think this is the kind of thinking and the kind of incentives we need to see to really mainstream responsible investment. And the last point probably isn't as potentially controversial as financial incentives, but it's also really important. It's about disclosure of climate risk by investors themselves. We found in our research that the majority of asset managers still haven't started publishing TCFD reports. It's 3 or 4 years now into TCFD. Certainly, if asset managers have shareholders, it's arguable that they have already a legal responsibility to disclose any financially material ESG risks. I think it's quite clear that climate change is financially material. But more than that, publishing a TCFD report, the process itself can drive organizational change and progress on managing climate risk. It brings people together from different departments. It prompts questions such as, have we done carbon footprinting? How do we link it into our voting and stewardship behavior? Have we done forward-looking scenario analysis? Just the process itself of asking these questions is really benefit and plus. So it doesn't matter if you're quite early on the TCFD journey. It's good just to get going there. The next point I wanted to quickly discuss is around voting. It's a real cornerstone of stewardship, and certainly it's I think one of the most powerful and next step actions that asset managers should take to really signal to the companies they're invested in that they want to see successful low carbon transition or a sustainability transition. We've seen a lot of voting policies that are quite good on corporate governance, but silent when it comes to environment and social issues. Yet from the leaders, we've seen very, very clear voting policies with strong commitments, detailed commitments. For example, on climate change, voting policies guiding how votes are cast in terms of disclosure, like TCFD we just discussed, as well as setting Paris-aligned business strategies, or even voting positions when it comes to corporate lobbying on climate-related issues. And we will be having some case studies looking at some of the best voting policies. I think RBC, Global Asset Management, have a really good voting policy with detail on these topics. And then the voting policy, they should translate into stronger voting action. And there's two sides of the voting coin. One is supporting ESG resolutions. We've seen more of them in recent years. The quality is getting a lot better. And certainly when it comes to climate-related resolutions, one of the big things we've noticed recently is that there's a league of US-based asset managers that have just skyrocketed their support for climate-related resolutions in the last 12 months. And just to signal how seriously that they're taking these issues. So, a question we'd want to present to the South African market is, how is voting power being used to support these important resolutions? The other side of the coin is leveraging voting power against traditional governance resolutions. And it's really interesting. In the last 12 months, we've seen the world's biggest asset manager, BlackRock, get serious on voting against directors when it comes to a lack of climate disclosure. I think they've voted against 62 directors on account of climate grounds, and there's plenty of other examples of asset managers starting to vote against directors or pay when ESG progress is not enough. So something to think about there. The third point, I think it's important that asset managers, when it comes to important, those ESG resolutions that matter, that they have a single voice on how they want to vote. So if there's a climate resolution at a bank asking for a fossil fuel phase-out plan, there shouldn't be split voting where asset managers have control. It should be a single holistic voice, just to signal how important those issues are, and not to send any mixed messages. So that's something that we've picked up in our conversations. And the last thing is really important, and it's a great starting point too, is just to make sure that there is transparency where votes are cast, especially around ESG resolutions, and to do so in a timely fashion. So not to wait 6 months, but to do it pretty quickly. And we've seen many cases of immediate disclosure of these votes, not just the votes themselves, but the reasons and rationales for them. And BlackRock's another example of change in the last 12 months. Have started publishing very, very detailed rationales on the key ESG resolutions, the controversial ones, the ones that matter the most. From a leading practice point of view, we'd like to see asset managers start pre-declaring their intention to vote on key ESG resolutions, and we'll be featuring some of this in leading practice as well. Quickly moving on to stewardship, and this is so important. We've seen tens of thousands of meetings between investors and their companies in recent years, yet progress has not been enough when it comes to decarbonisation or genuine sustainability pathways. So there's a little bit of an ambition gap. And there's a question here about the purpose of stewardship. Is it just to pick up a little bit of insight so you can make a little bit more money, or is it to be a proactive driver in the corporate change that we need? And this is certainly the attitude that a lot of the more progressive global asset managers in our research are taking, and they're doing the following things. They're setting clear expectations on issues like climate change, for example, TCFD disclosure, or setting science-based targets, or timeline objectives when it comes to phasing out unsustainable business practices. And then they enforce those in their engagement by escalating. And there's a lot of ways to escalate. AGM questions are just one example. Co-filing resolutions is another one. And what's really interesting is that here in Europe, ShareAction helped coordinate a resolution at HSBC asking for a strategy and targets to phase out fossil fuel financing. And that's been co-filed by, I think, around 15 institutional investors themselves who have been engaging with this company for a few years and would like to see more progress. So this is something we see happening here, and perhaps something we're thinking about in your own region. There are plenty of other escalation tools. We'd expect the escalation strategies to be public, and for stewardship reporting to provide progress updates on these. And this connects to the next point, that engagement should really lead to real-world change. We're seeing a lot of reporting saying that asset managers have engaged with X number of companies on X number of topics, but leading practice is saying that these are the expectations we made, here are the milestones, here's what's worked and hasn't worked, and here's what's next. And this is what we would really like to see moving forward. And I think they're the key points I wanted to make around stewardship. There's plenty more to talk about, but just to keep my presentation to 20 minutes, I might move on to the final slide. And this is, when it comes to these systemic issues, climate change, biodiversity, human rights, we really like to see asset managers have a position, to have a statement, to have a policy which touches on things like their investment decision making, their stewardship, their voting, their engagement, their risk management, and to make them public. And certainly in climate change, I think we've seen the most traction and activity in the last 6 to 12 months. We've seen a wave of net zero commitments from asset managers, which is quite new. We've seen them from asset owners for quite some time, but in the last few months, we've seen the Net Zero Asset Manager Alliance, which I think has 30 asset managers globally, commit to net zero portfolios by 2050. And a lot of the policies, excuse me, of these ambitious asset managers will also say, look, if we don't divest, then we escalate in our engagement, just to make our positions quite clear. And so having a policy really helps. I think in South Africa, things to think about might be, well, have you footprinted your carbon, your portfolios? Are you aware of the pockets of climate risk? Have you done scenario analysis? Are you aware about the balance of physical and transition risks and what it means for your portfolio in a 1.5 degree outcome versus a 4 degree outcome? And what do those mean for your engagement? And should you be highlighting particular at-risk sectors or key topics? And similarly for human rights and biodiversity, we like to see policies. I could talk for days about both of those, but I think I'm getting to the end of the 20 minutes. Maybe one quick note on human rights. We like to see approaches that make reference to global standards like the United Nations Global Compact or the Guiding Principles on Business and Human Rights or the OECD multinational guidelines, and how they're used in either screening for portfolios and funds or for stewardship. And certainly if there's a breach or controversial behavior, you would expect some activity to happen in those cases. And biodiversity, we think this is probably going to be the hottest ESG topic in 2021. We have a global convention later this year that will set the global ambition for the next 10 years. There's an enormous amount of finance at risk, not to mention life on Earth itself. It's as big a risk as climate change. We've seen, everybody knows about TCFD now, but now we have a TNFD, a task force for nature-related financial disclosures. So we think any responsible investor should start looking at biodiversity and doing what they can to get better quality data from companies and to highlight the issue in their stewardship practices also. So there you go, a quick whistle-stop tour. I hope some of these ideas are useful and inspiring. And I'm happy to, after the event, if anyone's got any questions, they can shoot me an email, and happy to carry the conversation forward. But Rob, I think I'll leave it there for now. I think I've hit 21 minutes.
22, but who's counting? Thanks very much, Peter. And as Peter mentioned, their report is freely available on the ShareAction website to download, and I really encourage you to take a look at that and see how thorough and comprehensive that report indeed is. Peter, first question I have for you is to talk about the follow-up engagement that you had with, you mentioned around 50 asset managers from around the world. We also found that part of our research the most valuable, because when you look at it on paper or the responses to the Responsible Investment Survey, it's quite flat. But when you go in and talk to the asset managers about what they meant by certain answers and start poking holes and getting responsive, well, actually we do a bit more than that. We found it quite enlightening and encouraging, and also they were very keen to find out where they ranked amongst their peers. You know, being asset managers, they're a competitive beast. So can you just share some of your favorite insights or what your highlights from these engagements were?
Yep, absolutely. And you're totally right. A lot of the time, there's a lot of activity behind the scenes that hasn't been made public yet, and sometimes it takes time to build a policy or a new engagement approach. And so it's super valuable for us. And we did see that there was a lot of willingness to make change, and a lot of things in action that just haven't been made public yet. So that was really encouraging for us, and we're seeing so much change already since we did the assessment, which was based on 2019 data. So it's almost a year and a half ahead. I think what was most interesting was talking to investors about this change in mind shift from a one-way view into how ESG issues affect financial performance, into thinking about, well, should asset managers be also taking responsibility for the real-world impact of their investments on society, on climate change, and this is a pretty big concept, but a lot of them are quite open to the idea, which I think was really reaffirming. And there's one example, or one highlight recently, is we had this discussion with a large Japanese asset manager last year, and since this time that they were really happy to let us know that now when they're doing the ESG materiality process, when they're deciding which are the most important ESG themes to look at in the coming period, they now look at impact on society when it comes to deciding those, and I think that this is really reflective of how asset managers are starting to take this sort of 21st century mindset around impact, and I think this will be one of the big trends moving forward. Also, once we start getting better data, but that ambition needs to be there first, and we've started to see pockets of that ambition. So that's been really inspiring from our side, and the other thing is just to see how much more willingness now there is to support climate resolutions, and there are 3 big US asset managers who have just started ramping up the support for climate resolutions. I mean, JP Morgan Asset Management, Northern Trust, Wellington, they all increased their support for climate resolutions based on a study we did from under 20% to almost up to 80% in some cases. So this is, when you get the ambition in place, then things can change quite quickly, and this should be a good message for other regions and other parts of the sector.
And as you mentioned, it is rapidly evolving and rapidly changing as new developments come out. But it's not something that the asset managers should feel behind the curve, right? Everybody's on a learning journey, and everybody can implement best the practices first that are easy for them to do, but also and make sense for them to do, but also make use of their current capabilities or their current resources. It's not about going out and introducing a whole new team at great expense. It's about using your current resources. And you mentioned the conceptual shift of those current resources or the investment teams. Question for you, though, really on that is, how can asset managers, asset owners, such as pension funds, consultants, and even policymakers, how can they use your research or the report that you produced to best effect? And maybe, do you have any recommendations of where they could start their journey?
Absolutely. In each of the thematic reports that we published, we do have a range of questions that are relevant for some of the investment value chain stakeholders that you just mentioned. We got a lot of calls from investment consultants after we published this, wanting to know more. Investment consultants, they do their own assessments of responsible investment for asset managers, and we're really interested in some of the questions that we were asking, and this is one of the reasons that we have full disclosure about the questions that we ask and how we weight them in our analysis. So I would say asset owners, pension funds, and investment consultants can use the questions and topics as a framework or a template when they engage with their own asset managers, both in their due diligence and also in monitoring their performance. And I think looking at voting activity and stewardship practices are some really good examples of that. I would like to say that looking at the incentives and how they're aligned with responsible investment is also really crucial. And there's a lot of information in our reports that are good for that. For asset managers themselves, because we have full transparency, any asset manager can take the questions and do a little bit of self-reflection and sort of rank themselves against just see where they are across these topics, and policymakers also can look at the regional performance based on our ranking, just to get a flavour of how of how the asset managers are doing in that particular region. So yeah, and when we have the leading practice guide out soon, that'll also have a how to use this guide section for the different stakeholders mentioned. So there'll also be clear guidance when that comes out in a few weeks.
And I thoroughly encourage people to make use of these resources. I think they're highly valuable. Peter, thank you very much for joining us, and I really appreciate your time today.
Thank you. It's been an absolute pleasure.